So for years now, anyone who follows the financial markets has been fed this very specific, really dominant narrative about the broader economy.
Oh, the retail apocalypse.
Exactly, the famous retail apocalypse. It's this pervasive idea that brick-and-mortar retail is essentially a terminal patient.
Right, like you picture an abandoned suburban mall, boarded up department stores, weeds in the parking lot.
Yeah, exactly. And the assumption built into so many investment theses is just that e-commerce has entirely, permanently hollowed out physical storefronts.
It's treated less like a market trend and more like an inevitable force of nature at this point.
It really is.
And, institutional memory latches onto that because it's a very clean binary narrative. Digital infrastructure wins, physical real estate loses. It's an easy story to tell on TV.
But then, you step away from those macro generalizations and you look at the actual financial machinery of a company that is actively proving that narrative completely wrong.
Right. The data tells a totally different story.
It really does.
Yeah.
Suddenly, that terminal diagnosis looks, well, premature, if not entirely ridiculous.
When you isolate the right operators in this space, physical retail isn't just surviving on life support. I mean, it's thriving. It's expanding.
Which brings us to what we're doing here today. Welcome to the Deep Dive, everyone. Today, we are taking a very close look at a company that is absolutely shattering that retail is dead myth.
And we have some great data to back this up.
We do. On the table for you today, we have two primary sources: the Q2 2026 earnings press release and the Form 10Q SEC filing for Agree Realty Corporation, ticker symbol, ADC.
Right. So Agree Realty is a real estate investment trust, or a REIT. And their specific focus is acquiring and developing properties that are net leased to industry-leading retail tenants all over the U.S.
Right. And our mission today is to unpack exactly how this specific retail REIT is breaking its own investment records and aggressively raising its 2026 guidance, basically defying every tired narrative out there.
Let's get right into those numbers.
Yeah, let's unpack this. We need to establish the baseline from their second quarter first. For Q2 2026, Agree reported a standard net income per share of 44 cents.
But, and this is key, for a real estate company, net income only tells a fraction of the story.
Right, because of depreciation and all that.
Exactly. We really care about their core funds from operations, or FFO, which increased 7.5% year over year to $1.13 per share.
Oh, okay.
And their adjusted funds from operations AFFO was up 7.4% to $1.14 per share, with total revenues hitting $205.1 million for the quarter.
So just to clarify for the listener, because you're probably comparing this to, I don't know, a standard tech or manufacturing stock.
Yeah.
Why exactly is AFFO the better metric here?
Yeah, it's a great question. So in real estate, standard Jack net income includes massive non-cash deductions, the biggest one being property depreciation.
Which GAAP assumes goes down to zero eventually.
Right. GAAP assumes a building loses value every single year until it's worth zero. But in the real world, commercial real estate usually appreciates.
Yeah, a physical building isn't a laptop. It doesn't just become obsolete in 3 years.
Precisely. So AFFO corrects for that. It adds back those artificial depreciation charges, but it also subtracts the real-world capital expenditures required to maintain the properties.
Like replacing a commercial roof or something.
Exactly, or repaving a massive parking lot. So AFFO gives us the most transparent picture of the actual cash this company is generating that can go back to shareholders.
And seeing a 7.4% increase in AFFO for a mature portfolio is, well, it's a huge indicator of underlying health.
Massive.
But we see the profits trending up. The fundamental question is why?
Yeah.
I mean, looking through the 10Q, this growth is being driven by a truly unprecedented volume of new property acquisitions.
It's their growth engine. It's running red hot right now.
Yeah, red hot is right. In just one quarter, literally 90 days, Agree Realty invested a company record $502 million.
Over $500 million.
Yeah. They acquired 102 retail net lease properties in a single quarter.
And if you zoom out to the first half of 2026, it paints an even crazier picture. Over 6 months, they deployed about $925 million across 187 retail properties.
Which is just staggering. And management is projecting so much confidence here. CEO Joey Agree specifically highlighted their fortress balance sheet in the release.
Right, and they actually raised their full-year investment guidance.
Yeah, they did. Originally, they told Wall Street they'd invest between $1.4 and $1.6 billion this year. Now, they bumped it to a massive $1.6 to $1.8 billion.
Which is a definitive signal to the market. Raising guidance mid-year tells investors they don't just have the capital, They have a highly visible pipeline of targets ready to close.
Okay, but I have to push back here because my healthy skepticism is definitely kicking in.
Fair enough.
Let's think about the logistics of this growth. Buying 102 commercial properties in 90 days means they are closing more than one transaction every single day, including weekends.
It's a relentless pace.
Right. Think about what goes into acquiring just one building. You have phase one environmental assessments, title searches, land surveys, deep legal underwriting for the leases, structural inspections.
That's a lot of paperwork.
How is a company closing a deal a day without cutting corners? Are they just, like, throwing darts at a map and vacuuming up whatever they can find to hit these targets?
Your skepticism is entirely justified. I mean, when any company scales that rapidly, the immediate fear is reckless expansion.
Yeah, growth at all costs.
Exactly. But diving into the actual property data reveals a highly structured, programmatic strategy. It is so vital to understand what they are buying.
Okay, lay it out for us.
They are not negotiating complex, multi-level mega malls with dozens of moving parts and zoning issues. They are exclusively acquiring freestanding, net-leased properties.
Meaning a single building on its own land with a single tenant.
Right. And the net lease part of that equation shifts the burden of operations entirely.
Because it's a triple net lease, right?
Yes. In a triple net lease, the tenant is contractually responsible for the property taxes, the building insurance, and the structural maintenance.
Wow. Okay.
So Agree Realty is essentially just providing the capital for the real estate and collecting a highly predictable rent check. The operational friction is incredibly low.
Which allows them to standardize their due diligence and scale up without needing an army of property managers.
Exactly. The speed isn't a symptom of recklessness, it's a byproduct of a highly repetitive transaction model.
Okay, that makes sense. But what about pricing? Are they overpaying just to win these deals?
Not according to the data. The filing notes they're buying these new properties at a weighted average capitalization rate of 7.0%.
Let's pause and define that for you real quick, because cap rates are the heartbeat of real estate valuation.
Right. Simply put, a cap rate is the expected annual return on a property if you bought it entirely with cash.
So if you buy a building for $1 million and it generates $70,000 a year in net operating income, that's a 7.0% cap rate.
Exactly. And in the current 2026 economic environment, acquiring assets at a 7% initial yield provides a very healthy spread over their cost of borrowing.
And crucially, they are locking in a weighted average lease term of over 11 years on these new Q2 acquisitions.
Yeah, they are securing over a decade of predictable cash flows the moment the ink dries.
But, locking in an 11-year lease is great on a spreadsheet. But a contract is only as reliable as the entity signing it.
Oh, absolutely.
If the tenant goes bankrupt next year, that 11-year lease is just an expensive piece of paper. This requires us to look at exactly who is occupying these buildings.
Right, because tenant credit quality is the ultimate safety net for a REIT. If the tenant fails, the landlord suddenly absorbs the taxes, the insurance, the maintenance.
And a total loss of revenue until they find a new tenant.
Exactly. It's a nightmare scenario.
So let's examine the who and the what of this portfolio, which I view as their anti-e-commerce shield.
I like that term.
Thanks. Since they're expanding at breakneck pace, we need to stress test the businesses occupying their massive portfolio of 2,825 properties across all 50 states.
Well, the first metric that jumps off the page is the occupancy rate.
Yeah, 99.8% leased. That is insane.
It represents effective maximum capacity. In any portfolio this size, you'll inevitably have a fraction of a percent of space in transition or renovation.
But 99.8% means practically every square foot of dirt they own is generating revenue.
Right. And across the entire portfolio, they maintain a 7.7-year weighted average lease term. But the actual tenant roster is what solidifies this.
It reads like a roster of retail survivors. Walmart is their top overall tenant, accounting for 5.8% of annualized base rent.
Tractor Supply follows at 4.7%, Dollar General at 3.7%, and Hobby Lobby at 3.4%.
What's fascinating here is the deliberate defensive curation. If you break down their rental revenue by category, grocery stores lead the pack at 10.1%.
Home improvement is second at 9.0%. Convenience stores rank third at 8.3%, and tire and auto service is 7.4%.
When you look at those sectors, a very clear operational theme emerges, doesn't it?
It does. It's all about immediacy and physical necessity.
Exactly. You cannot easily download these products.
Yeah.
And when you need them, you usually can't wait for a fulfillment center to ship them.
That is the crucial distinction. The data shows that 65.8% of their base rents are generated from investment-grade retail tenants.
Massive. incredibly well-capitalized corporations.
Right. Realty is hyper-focused on essential, recession-resistant, and fundamentally omni-channel businesses.
And by omnichannel, we mean businesses that haven't stubbornly ignored the internet. They've integrated their physical stores to act as distribution hubs.
Walmart is the gold standard for this, right? Using their stores for same-day grocery pickup and delivery.
Yeah, exactly.
Yeah.
Or consider the consumer behavior for Tractor Supply, which is nearly 5% of Agree's rent.
Right. If you need a 50-pound bag of livestock feed, you're not paying overnight shipping fees. You're driving your truck to a physical store.
Same logic applies to O'Reilly Auto Parts. If your car's alternator fails on Tuesday morning, you cannot wait 3 days for a part in the mail. You need it right now.
This connects directly to the broader economic reality you interact with every single day.
Right. When you hear talking heads declaring the death of retail, this portfolio shows exactly how physical retail thrives today. People will always require groceries, auto repairs, and convenience items.
Agree. Realty isn't betting against the internet. They are strategically betting on the basic physical necessities of human life.
And structuring their real estate to serve as the indispensable final mile for those necessities. You can even see this defensive posture in their ground lease portfolio.
Oh, the ground leases are a great example of this.
I noticed that in the filing. Can you explain the mechanics of a ground lease for the listener and why it's considered so safe?
Yeah, so a ground lease is a structure where the REIT only owns the literal dirt, just the land. The tenant is responsible for actually funding and building the physical store on that land. Agree's ground lease portfolio is fully occupied with an 8.9-year lease term.
And 85% of that rent comes from investment-grade tenants, right?
Exactly. It is highly defensive because if the tenant ever defaults on the lease, Agree gets to keep the physical building that the tenant paid to construct totally for free.
Wow. So the land is secure, and the leverage heavily favors the landlord.
It's an incredibly strong position to be in.
So, okay, we've established they're acquiring billions of dollars in real estate, leased to top-tier tenants, protected by these favorable lease structures.
Right.
But the elephant in the room is the financing. Here's where it gets really interesting. How does a single company generate the capital to pay for $925 million real estate in just 6 months without drowning in toxic debt?
The capital market strategy is arguably the most sophisticated component of their entire operation.
Because digging into the 10Q, their primary funding mechanism seems to be their ATM or at-the-market forward equity program.
Yes, the ATM program.
The filing details that Agree currently has 14.5 million shares outstanding under forward equity agreements, projecting to raise about $1.1 billion. Combined with cash and credit, their liquidity is an immense $1.9 billion.
That's a lot of dry powder.
It is. But we need to clarify this forward equity concept because it sounds like financial wizardry. Is this essentially like securing a giant pre-approved line of credit from the stock market?
That's a pretty good way to think about it.
Like, they lock in the price of their stock today, but they don't actually take the cash or dilute their shares until they're ready to buy a specific property.
That analogy captures the mechanics perfectly. A forward equity agreement is an incredibly powerful tool.
How does it differ from a normal stock offering?
Well, in a standard offering, a company issues shares, takes the cash immediately, and their earnings per share are instantly diluted.
Right, the share count goes up immediately.
Exactly. But with a forward agreement, Agree can look at their stock price today, decide it's trading at a favorable premium, and sign a contract to sell shares at today's price in the future.
They don't issue the shares or take the cash on day one.
No, they don't.
And the filings show they have settlement dates stretching all the way between October 2026 and April 2028. Why is that delay so financially valuable?
Because it eliminates what we call cash drag.
Cash drag.
Yeah. If Agree took that $1.1 billion in cash today, it would just sit in a bank account yielding minimal interest, while the newly issued shares would immediately dilute their earnings metrics.
Wall Street punishes companies for inefficient capital allocation.
Severely. By utilizing forward equity, they lock in a highly favorable cost of capital. Then 2 months later, when they finally underwrite a new Walmart property, they settle a portion of that contract, draw down the exact cash needed, and buy the building.
Wow. So the new rental income hits the income statement at the exact same moment the new shares hit the balance sheet.
Exactly that. It perfectly matches the funding liability with the asset acquisition.
That is remarkably clever. It effectively insulates their growth pipeline from market volatility. Like, if the stock market experiences a severe correction next month, it doesn't derail their $1.8 billion acquisition target because they've already secured the capital at today's pricing.
And you can clearly see the protective impact of this strategy in their leverage metrics, too.
Oh yeah, let's talk about leverage.
In the standard filings, their net debt to recurring EBITDA, which shows how many years it would take to pay off debt using current earnings, stands at 5.2 times.
Which, in commercial real estate, is generally considered a manageable level.
Right, it's healthy. But the filing highlights that when you calculate this leverage on a pro forma basis, including that forward equity, the ratio changes dramatically.
Because pro forma means calculating it as if a future event has already happened, right?
Exactly. If we assume they settle all 1.1 billion of those forward equity contracts today, their leverage ratio plummets from 5.2 times down to 3.7 times.
Wow. 3.7 times net debt to EBITDA is exceptionally conservative.
It provides them with a massive buffer against economic shocks. A true fortress balance sheet, just like the CEO said.
I also noted they drew down the remaining $100 million on an unsecured term loan maturing in 2031, and they fixed the interest rate at 4.02%.
Which is a huge win in this rate environment.
Locking in a 4% borrowing cost for the next 5 years is a significant operational victory given recent macroeconomic volatility.
It really demonstrates a management team that is meticulously focused on risk mitigation. They're aggressively expanding while simultaneously de-risking the balance sheet.
Walking that tightrope is incredibly difficult, but the data suggests they are executing it with precision.
They absolutely are.
So this transitions us to the most vital question for the retail investor listening right now. A fortified balance sheet and brilliant equity programs are great for the company, but what is the tangible payoff for the individual holding ADC shares?
The ultimate tangible payoff for the shareholder is the dividend. And notably for Agree Realty, it's a monthly dividend.
I love that. Monthly dividends carry a unique psychological benefit for retail investors, especially those relying on income.
It matches up with how people actually pay their bills.
Exactly. In Q2, Agree declared a monthly dividend of roughly 26.7 cents per share. Annualizing that brings it to about $3.20 per share for the year, representing a 4.3% year-over-year increase.
They aren't just maintaining it, they're growing it.
Right. But if we connect this to the bigger picture, a growing yield is attractive. But the safety of that dividend is paramount.
A high yield is a trap if they have to cut it during the next recession.
Right, which requires us to look at their payout ratio, the mathematical relationship between the true cash they generate and the cash they distribute.
And the SEC filings reveal their dividend payout ratio is currently sitting at 70% of their adjusted funds from operations, or AFFO.
Meaning for every dollar of actual cash profit the real estate portfolio generates, they distribute 70 cents to the investors and retain 30 cents internally.
Which is widely considered the absolute sweet spot for a net lease REIT. A 70% payout ratio ensures the dividend is highly insulated.
Even if a few tenants go bankrupt unexpectedly, the dividend isn't threatened.
Right. Furthermore, retaining 30% of their cash flow translates to tens of millions kept safely inside the corporate structure. They can deploy that to fund new developments or pay down debt.
It creates a self-funding growth loop.
Exactly.
And regarding portfolio optimization, I found a detail in the 10Q. Proving management isn't just hoarding properties to inflate their asset count. They are actively engaged in what we might call weeding the garden.
Yes, the disposition strategy is just as vital as the acquisition strategy.
During the second quarter alone, they sold 14 properties for $30.3 million at a 7.1% cap rate.
And for the entire first half of 2026, they disposed of 21 properties for almost $41 million.
It shows a willingness to actively prune the portfolio. If a local demographic starts to deteriorate or a tenant's credit rating slips, they don't passively wait for it to become a vacancy.
They sell the asset, capture the capital, and recycle those funds into a stronger property.
That active management is the hidden engine behind maintaining that stunning 99.8% occupancy rate. You have to remove weaker assets to protect the whole.
Active disposition requires immense discipline. A common trap for real estate operators is falling in love with their own assets and refusing to sell, even when the fundamentals deteriorate.
Agree treats their portfolio as a dynamic, evolving entity rather than a static collection of buildings.
It really is a masterclass in modern commercial real estate strategy.
It is. So let's recap the core takeaways from our deep dive into Agree Realty today. First, we observed a company executing a disciplined yet highly aggressive acquisition pipeline, adding a property a day, but strictly focusing on investment-grade, internet-resistant retailers.
Second, we analyzed their highly effective ATM forward equity program. It allows them to lock in their cost of capital, insulate the balance sheet, and perfectly match funding with acquisitions, giving them a pristine pro forma leverage ratio of 3.7 times.
And finally, we looked at the shareholder reward, a secure, well-covered monthly dividend that continues to grow, supported by essential retail tenants that you interact with every week. So what does this all mean for you listening?
Yeah, why does this matter?
Well, this exercise is exactly how you look past a dense SEC filing to uncover the actual beating heart of a successful enterprise. We open by referencing the narrative that physical retail is dying, yet the empirical data paints a picture of a company building an empire on the exact opposite reality.
But this raises an important question, though, and it's an analytical puzzle I really want to leave you to chew on.
I always appreciate a complex problem to wrap things up. What's the overarching risk here?
Consider the metrics we discussed. With the portfolio 99.8% leased, and those leases locked in for 7.7 years on average, the existing 2,825 buildings are basically at maximum capacity.
Right, they're generating reliable cash, but they can't organically generate massive new growth on their own.
Exactly. This mathematical reality dictates that Agree Realty's future growth relies entirely on their operational ability to continue acquiring new properties at a massive scale.
Oh, I see where you're going.
As they grow larger, the law of large numbers becomes their biggest hurdle. How much operational pressure does it put on their internal team to continually source, underwrite, and close $1.8 billion worth of high-quality real estate every single year?
Right. Finding 100 perfect properties is an achievement. Finding 500 perfect properties year after year without compromising your standards.
That is a monumental challenge. What happens to this phenomenal growth narrative if that finite pool of perfect internet-resistant real estate eventually begins to dry up?
That is the ultimate, unavoidable tension built into any wildly successful growth model. At what point does a company simply run out of viable runway?
It's something investors need to keep an eye on.
It's a fantastic thought exercise to take away from this analysis. Think back to our terminal patient from the beginning of the show, the physical retail sector that consensus told us was dying. It turns out they aren't just surviving, they are running marathons.
But sustaining a marathon pace requires constant premium fuel.
And sourcing that fuel only becomes more difficult the further you run. Thank you for joining us today for this analysis. If you enjoyed this, be sure to follow the deep dive for our daily earnings coverage. Keep looking past the sensational headlines, keep digging into the raw data, and as always, keep questioning the consensus.